Hey everybody, Greg Barron, aka Professor of Real Estate. Thanks for joining me again. Today we're going to talk on this module about a capital stack. Now, a capital stack are the different levels of financing that normally goes into any development projects. Sometimes you will use one, sometimes you will use all of them. But the reason it's called a stack is because it stacks from lowest risk and highest return all the way up to highest risk and lowest return. So the best way to describe that is, once again, is to go into ProformaPlus, because I've got it in relationship to highest risk, highest return, all the way up to lowest risk and lowest return. So I'm also going to throw up another chart which I've used in a prior video on my YouTube channel, which gives a representation of what this stack entails. And you'll notice the higher you go in preferential risk or the lowest risk, the lower return that you always have. So let's jump into ProformaPlus again. We'll start in the Project Center, and you'll notice we have a tab specifically for capital stack. And if you're using an Excel spreadsheet, you'll have also different levels of this financing stack that we're going to use. But as we open this up, you'll see that we go from common equity to preferred to mezzanine debt all the way up to senior debt. Now, again, as I previously mentioned, you're going from the highest return to the highest risk up to the lowest risk and the lowest return for a good reason. Your common equity, as we open it up, is usually the ownership group that's bringing this project to the lenders for ultimate financing. That usually is either a single person or friends and family, which is a limited partnership. Many times they break it up into a sponsor and limited partners with a promote that pays you for the extra work that you do. But you can see that in common equity, that's usually where you're raising the money for the initial equity. It will also have the highest risk. Many times you'll have personal guarantees for your founding members, but you also have the opportunity to have the highest amount of return. Then it moves up the risk level to preferred equity. Preferred equity are those people that invest in your project that have a specific return on the equity that they put in. They don't participate normally in the incremental increase of the value. For example, if we have a $1 million building, we will give a preferential return on $100,000 that you invest at 9%, but you won't participate if we sell in 5 years and make another $1 million on top of that. Usually preferred people, preferred investors only want a specific return on the equity that they are giving you. In the stack, they are preferential only above the common equity members. That means that they get paid before the common equity people, but they don't get paid before the next level that I'm going to describe, which is mezzanine debt. So mezzanine debt normally, and this could have several variations. Sometimes I've seen mezzanine debt that does have a value component to it, saying that they participate in the incremental increase in value. But normally, mezzanine debt is short-term debt. It is a return before preferred and before common, but prior to senior debt. And again, normally it's used as a type of bridge or gap loan. I've seen these go a year, sometimes they go 6 months, but normally they're not over 2 or 3 years, and they're typically at a much higher rate of return. So the last stack is senior debt. Now, typically, senior debt is going to be your banks and your lending institution that are going to have a first lien position in front of everybody. Again, it is the lowest risk and the lowest return, because if everything went to hell in a handbasket, they would be the first ones to get paid. And then in the stack level, it would be the mezz debt, and then the preferred, and last would be the common equity. So the most important thing to remember in financing, there are different arrows in your quiver to be able to use to raise both equity, to pay preferred, to have short-term gap that maybe there's a shortfall in what the bank at the senior level won't lend you. They'll step in at a higher rate. At today's rates on mezz debt, I've seen 12 to 15%. Senior debt, right now, it's 7 to 8%. Preferred equity, 9 to 11%. And then your common equity typically are those people who usually start the project in the beginning, and they participate in the value creation over the life of the project. That's just an introduction to capital stack. We'll get further into mezz and preferred equity in another module. Hope that helps. We'll see you soon.